Welcome back to the Beat the Odds of Business and Wealth podcast, Trevor. Very important episode today because we're focused on RRSPs.
RRSPs. We have said it multiple times over the years that we've been together that RRSPs are a scam. And, this story kind of highlights the reasons why people should, perhaps think of other investment vehicles other than RRSPs.
Yeah, because that clip on Instagram, right? When we start posting the social media, we get the clip on the Instagram, and then all of a sudden it's like, Ty posts that one clip of me calling RRSPs a scam at the boot camp, and I was like, I got like 1 million views or something. I was like, I guess everyone knows how I feel now. I used to just tell the attendees of the boot camp, but I guess we're going all in on this. This is the hill I'll die on because, it is a scam. It's a payday loan of tax planning strategy. It's completely overused. It's completely misunderstood. There's so, it's like it's used 99% of the time, and it probably should be used 1% of the time. That's the tool, right?
Yeah, exactly. And the thing with government programs is they roll them out and they say they're going to be so helpful for you, but at the end of the day, very very small use case for them. Maybe you can get into that sometime during this podcast to explain the scenarios when it makes sense to have an RRSP.
Yeah.
And strictly just for tax planning in a given year, but we'll get into that. So What's the story we got for everybody today?
I mean, this is the story. We'll go to the screen here, and I'll read this through because you sent me this one. I was like, oh man, this happens. Doesn't happen to our clients, but this happens, and this happens a lot at scale, right? Okay, and the headline reads, it's daughter hit with a $660,000 tax bill when both parents died in the same year. Okay, when both parents died in the same year. So we'll go through the scenario. So Ontario woman says she had to use nearly all of her parents' retirement saving plan to pay off more than $660,000 tax bill if they both died within the same year. Okay. Ashley said she and her brother were grieving the loss of their parents, and they received the tax bill from the government. It made me more angry than anything. We lost both parents inside of 11 months. Okay. We think, we think my dad died of a broken heart. This is actually this is a real thing. You know what I mean? This is like anecdotally, I experienced this, it's like I've been doing this long enough where you see people pass away, and it's really not unusual when someone close to them passes away. When one spouse passes away, the other one is not that far behind, right?
Yeah, that's true.
And the default in RRSP is like, it transfers to their spouse, but usually that other spouse isn't going to outlive them, right? It's like we just don't have this real discussion on RRSPs. It's just like, that tax is someday. It's like this thing. I tell everyone is like, I wish these things just came in the mail and it said this is a joint account between you and Mark Carney.
Yeah.
Like it is just, it is a joint account. You are never getting 100% of that out. You feel good because you see that number, but it's not yours. You're going to lose, in 99% of the cases, you're going to lose 25 to 50% of that in tax at some point. Like that is, how this thing is going to materialize, right? And before the people out there, it's like, but you get your credits and your tax free. Like your CPP and your OAS are going to eat up most of those credits. Like you're paying tax on that RRSP withdrawal. This is over and above. So you're going to pay somewhere between the first rate and the top rate, right? So that's how these things materialize, right?
It's not a gift from some benevolent government.
And if you're a financial advisor out there saying like, well, your income is going to be so low, it's like, what the hell did you do with their funds during their working years that their rate of return is that low? Like what were you doing up until this point if you don't have any investment income? Like, these guys, they just like drive me up the wall. Like this is like the quintessential problem because these people, didn't deserve that, right? Galen describes her parents as middle class, working hard in their careers in nursing and business to save up to buy a cottage in 1998 and contribute money to their registered retirement scam plans. Okay. And when they both died last year during the same calendar year, Gailey's mother RSP rolled into her father's RSP for a combined $715,000. So yes, it will roll to the next spouse. Yes, but you haven't solved the problem. Your RSP is not intergenerational wealth plan. It's a tax confiscation plan.
Yes.
It's a partnership. It's to turn your investment income that's otherwise taxed at better rates into the worst type of tax at other income rates and withdrawn all at once on the date of death eventually. That's what's coming, right? Okay. And so when her father died, the RSP amount had to be taxed as income at about 50%. 50%. So not at a capital gains rate. You're not getting, eligible dividends at preferential rate during the life of it. It's like it's all going to come in as other income at 50% on the date of death. Yeah, could be, it could be a little less than that because you might have some use of your other marginal tax brackets before them. But this is common. Like this is common for people who have substantial RRSPs, and I see them, and it's like, they come in and they're at retirement and they got $1 million in RSPs. It's like, what are you doing? Like, what are you going to do with this, right?
Yeah.
Like this is a very serious problem because you're in basically a punitive tax vehicle. And the longer you go in that punitive tax vehicle, the worse it gets. Okay. And this is further compounded by another common problem that other people have. Okay. So even though they lived at their cottage for the last 5 years, Revenue Canada still wanted a portion of their capital gains of that property from the time they owned it from 1998 to 2019. So, a lot of Canadians have more than one property. This is a common thing. They save up, they get a rental property, they get a personal use property, a cottage. Okay. You can only deduct, you can only protect as a couple one residence as your principal residence. Only one residence as your principal residence. It doesn't have to be the one that you live in the most. It has to be a residence that you ordinarily inhabit, but only one. Okay. So in this case, it looks like they had another residence in the city that they were using to protect their principal residence, and then they sell the house in the city in 2019, and so now they're protecting the gains on the cottage from 2019 moving forward to 2024 or 2023. But it doesn't negate the gains from 1998 to 2019. So yes, someone told them you can roll that, you can defer the gain on that. And yes, that is the case. You can defer the gain on that. But again, it was just someone kicking the problem down the road. It was a tax advisor kicking the can down the road saying, yeah, we can defer that gain from 1998 to 2019. What they should have said is, I have no idea how to get out of it after that, though. You know what I mean? Like,
I have a question, though. Okay. Yeah. So the cottage was, really their secondary property up until 2019, 2020, when they decided to move into it and turn that into their primary residence. Now, it says in the report that the government wants the gain from 98 till 2019, 2020. How are they going after that gain? Just because they died, or the inheritance tax?
They changed
I don't understand
the use.
That. Yeah.
So when you change a property use, so when you change it from personal use or principal residence or investment property, there's a deemed disposition for tax purposes. So in other words, there was tax owing on that gain because it was a personal use property from 1998 to 2019, not protected by the principal residence deduction because they had another property protected by that at that time. And so there was a deemed disposition. But there is a provision in the income tax to let you defer that gain. So really, when they filed their 2019 return, they had a gain, okay? But it was deferred, which is allowed. You can defer it. But again, it's not a strategy. It's, it's a Band-Aid, right? It could have been part of a strategy, but it's not a strategy, right? Just like that RRSP. Okay. And this is the problem, right? Someone was filing that return year after year after year. And someone, probably one of the big five banks, I don't know for sure, but the law of averages, probably one of the big five banks, managed that RRSP. And they talked to these people probably year after year after year and showed them some automated report and did not understand this massive, massive issue that they had, which should have been ridiculously obvious, which would have been ridiculously obvious to someone like me walking through the first initial client meeting. I'm like, oh my goodness, we have this issue. We need to act, right? And making some difficult choices, coming to the realization that RRSP account is actually a partnership with the government. It's never coming out tax-free.
Right.
Okay. So we have to minimize the tax on those withdrawals. And now we have this piece of real estate, which there are strategies to pass real estate to the generation, either in part or in whole, without tax to future generations. And it really does coincide with their liquid investments, right? But I have yet to see a big bank financial advisor ever, even though they're managing most of the wealth in Canada, ever come up with an effective strategy on how to mitigate this, right? All they do is they just sell you underperforming assets with high management fees year after year after year, and they once in a while they'll throw fancy events, but there's no real strategy that I ever see out of it, right?
No.
So, I mean, that's what I had. And these people walked towards that. And so then what happened was all of that tax became due on the date of death. So it was deferred. The RRSP tax was deferred when mom died to when dad died, but he died in the same year. And the previous deferral that they recognized in 2019 on the gain of that cottage was at that time. Okay. This is a quintessential Canadian example. Massive RRSPs, second property with massive gains, no way out, no strategy, no planning at all, right? And here, I'll give you another wrinkle of it. This doesn't say this in the article, but a common, a common, further complicating factor is there was probably some debt on the cottage.
Oh,
Can you imagine that? Like, so now the next generation, not only is all the savings evaporated, because that RRSP, I think it says in here that RRSP was $715,000, and the final tax bill was, $660,000. So like 94% of the RRSP, the savings is gone, right? And they probably have to pay for their final filings. The same guy who didn't recognize this was coming for years, and a lawyer to do the probate. So of course they got to pay for a funeral and that sort of thing too, right?
Yeah.
And I like how it throws in there that but they had a little bit of life insurance, as if that's a strategy. So we're going to buy this other underperforming asset to pay this outrageous tax bill, rather than try to allocate your assets to avoid the tax bill in the first place. Like, that drives me up the wall with a life insurance salesman pop in. It's like, you could have bought this life insurance policy, yielding 4 to 6%, when I could have showed them how to get 10% plus tax free. So this is, the example is, like I said, the complicating factor that a lot of people have. Big RRSP, they have a gain in a second property that with nothing on it, and then a lot of times they have debt on that second property. So now the person inherits next to nothing, and guess what? They got a mortgage payment. They might not even qualify for the mortgage.
Oh man! So they lose the property,
and sometimes they got to sell it like fire sale type sell it, right? Because they can't even they can't keep up with the mortgage payment, or they can't requalify for the mortgage, and then the whole thing, and then maybe you got a second property and that's worth $800,000, but you got to dump it at a time that's like now when interest rates are high, and you end up having to dump it at less than what you would in a regular time, right? This is the quintessential problem. And, we see them, and they're just like hundreds and hundreds of thousands of dollars or millions in registered accounts, and no way out, and no strategy at all being applied to these, right? So this is the example that people are walking towards, right? And I think a lot of it, Trevor, has to do with the misconception of like what retirement should be, where the kind of the poverty mindset in retirement is, I'm going to sell off my assets as I die.
Right.
I'm going to sell off my assets as I die. That's not the goal, people. Like I start like eliminating, like when we start doing our plans, I start eliminating the word retirement because I think it's stupid. Yeah. It's like, I'm going to just sell. Well, how long are you going to live? I don't know how long you live. So what if you sell them off too quickly? Or what if you don't sell them off quick enough and you die with a massive tax bill?
Right. Well, I mean, we've talked about this a lot of times. I think the goal is to pass it to the next generation, right?
Yes.
Doing it in a wise and well thought out way, to the next generation through trust, through family office, through some way, so that that wealth is it grows and it's preserved and it grows for generation after generation. I don't know where this stuff came from, where, you know, we are encouraged to completely, you know, eradicate all of our savings so that all the struggles and all the trials and all the hardships that we had to go through to build and generate wealth, we got to make our kids go through that same thing. It's like, that's
in
so
a worse environment,
retarded.
in a worse environment, because
Yeah.
the wages buy less and less of the desirable assets.
Yeah.
You know what I mean? Parents bought houses with, you know, 6 years of median income, and we buy houses with 16 years of median income, and our kids are going to buy houses with 60 years of median income. Like, this is coming. This is coming. And so, like, I tell people, it's like, eradicate the word retirement from your dictionary. Start there first. This is, you know, this might be a hard shift for people to do.
Yeah.
The goal is not retirement and sell off your assets. The goal is financial freedom. You obtain financial freedom when the dividend income and the rental income of your investment, so the investment income, exceeds your living expenses.
Yes.
That is the goal.
Yes.
That is the goal, because the other lie that everyone's trouncing towards is like trying to predict their date of death as if they're, you know, Nostradamus or something. They're also saying we can predict the rate of inflation while the dollar is self-destructing before our eyes, right? So I see them like laughably apply this like 2% inflation fee as if it hasn't been speeding up at all, and, you know, as if that $100,000 is going to feel like 100,000. You know, as if I increase that by 2% a year, that's going to feel like the same purchasing power in 10 years. It's not, people. It's not. So you need to derive, you know, dividend and rental income that are actually going to keep pace with real inflation, where I can actually raise rents, and I'm actually, you know, I have stocks that generate a yield that have pricing pressure on their customers so they can raise prices. I don't want to sell those units. I want to acquire those dividends, right? And that's how I show people how to do this, right? It's like, that is the goal. And whether you're 30 or whether you're 80, you're free at that point.
Yes.
But if your goal is to sell off your stuff before you die, it's like, you better not you're too healthy, because it might not work.
Yeah.
And
what if you live to 95, right?
And
you're out of money.
And what inflation rate are you using on that? Because
Right.
why are you so sure on that, right? You know, we've been telling people it's like, this used to be 6%, right? But you can look at the price of gold today. It's like, you could have bought lumps of gold and got 10%. You could have got a 10% compound annual growth rate in the last 25 years, right? At this point, like, beating the TSX, beating the S&P 500 by a pretty large margin at this point, right? Where people don't understand the actual rate of inflation. And so, you know, this is the warning sign, right? Where they're just like, well, what's the tax on that? What if they both pass away at the same time? It's like, well, A, they are going to pass away at some point, right? And B, like, the goal wasn't to sell the stuff up. The goal was to generate enough income that you're not selling off, that you're living off the investment income of those assets. But most people don't have a hope of doing that because the assets that they're in are so underperforming. Just like the tax advice of whoever sold them this RRSPs, the investments themselves, I'm going to guess that they're just similar to most of the balance funds out there in the big banks, and they're 5 or 6%. 5 or 6%, right? So, you're not actually keeping pace with the real rate of inflation. You're actually, your wealth is getting destroyed slowly with 100% certainty, right? You got 40% of the wealth in underperforming bonds, which those institutions need you in those bonds because they hold those bonds as a reserve assets. Between the top 5 banks in Canada. The top 5 banks in Canada and the top 3 insurers, collectively, they're worth about $1 trillion, and collectively, they have $2.5 trillion of bonds on their balance sheets. So why do they need you to have 40% of your portfolio allocated in bonds? Because if people stop buying them, they're bankrupt.
Yes.
That's it. Yeah. Not because it's good for you, right? Yeah. I mean, one of my favorite clients, it's interesting to meet with him. He's a CFA. He's a chartered financial analyst, and I won't out him. He was a fixed income analyst. He's a fixed income analyst for a major municipality in Canada. Fixed income analyst he was before he retired. And you know what he doesn't own?
Bonds.
He doesn't own any bonds. So his entire life is analyzing bonds, but he has 0% of his portfolio allocated to bonds. So like, I don't know how he, like, the cognitive dissonance of doing that year after year, day after day, but he did it, and he's a happy guy, and it's like, I don't know, he compartmentalizes it well, but it's really funny that he's he's an expert in bonds, and he would just never buy it for his own portfolio, right?
Yeah.
And totally retired. None of this bullshit where like you're slowly allocating into bonds over time as I get older. It's like, yeah, I'm slowly allocated into the asset that's destructing my generational wealth as I get older. Like that's a great idea.
Yeah.
That's a fantastic idea, right? And so this is it, people. Like who the reporter, like what they should have asked them, who sold you those RRSPs? Who sat down with you year after year and told you that this was a good idea, right? Now I have a good idea. Like I would say with 80% certainty, it's one of those household names. It's one of those big five, big five banks, top three insurers. Like that's who walks them through this garbage year after year, right? Where they just don't understand people. That person who you're meeting with is like, they might know with all the best of intentions, but they actually just don't even understand money at a fundamental level. They just don't even understand money at a fundamental level. And they weren't willing to have the difficult conversations because it was just about, their assets under management. They increase their book of business and they get their trailer fee off of these things. And that's all it was, right?
All they're thinking about is today thinking about their paycheck that's coming down the road, their commission check, and making sure that they're, get their 25-year coin for being at the bank for so long. And look how many assets I have under my management.
That's right.
The thing that really disturbed me about this story was this is, like you said before, this is a common Canadian story. People thinking they're doing the right thing. They're playing by the rules. They're working. They're saving in their RSPs. They were able to save up and get a cottage when it was affordable, and they did everything right, right. But then come death, and they wanted to transfer this to their kids. I assume they did. And they're punished for it, like punished hard. Like the person who dies, they don't get the punishment. It's the people who are left afterwards. And that's really what we're talking about is, having everything set up in such a way so that when you pass on, you're actually passing something on rather than giving it the inheritance to the government.
That's right. In this, it's like they died early. Imagine if they died later. Now they've been drawing down that RRSP.
Right.
Guess what? They still owe the tax on that gain in the cottage and wouldn't have any money to pay it.
Right.
They wouldn't have any liquidity to pay it after they had their wealth confiscated, slowly over time, because they're still going to pay tax on those RRSP withdrawals. They're still, probably eroding their real wealth away because they weren't earning enough inside of that RRSP anyways, right? And it's like, just think of how like nefarious it is, because they tell you it's like the advisor gets paid a percentage of your fee. Okay, they get paid a percentage, but look at all the scenarios where that puts people at odds. It's like, we don't do that. Like we charge flat fees. I was like, if your portfolio is $1 million, or if your portfolio is like $3 million, the plan doesn't change. The amount of times that I'm going to sit down with you is like it's not changing, because I'd sit down with them and say, great, anytime I can get that money out of the RSP, if I can get it out of the first tax bracket, I'm taking that deal. But why wouldn't a bank advisor do that? Say they can get money out at 25%. Say they can get $100,000 out of 25%. Neither of them were working 1 year. It's like, because what happens to that? Now that portfolio, they're not getting their management fee on $700,000. They're getting a management fee on $600,000.
Yes.
So they won't tell you to do that, right? They like that big number. They're a partnership in that too, right? Just along with the government is that bank advisor who's taking a trailer fee. It's like people need to get control back of these accounts and actually learn this stuff, because what they're doing is not that. It's not that difficult. I guarantee you, Sally down at the RBC, who I always make fun of, is not some, a quant trader who's out trading the market at all. Right?
Yeah.
She just buys what's on her screen, the 60-40 split.
Yeah. I mean, she's still showing up for work every day at her job at the RBC, getting paid her paycheck, and probably has to put some money into some kind of a shared RSP savings plan as well at her own bank. It's like you said, it's very nefarious, and people are in partnership with the government and the banks. And remember, it's your wealth, people. It's your wealth. It's your inheritance. It's what you worked for. So do the smart thing with it, and look at other ways. Educate yourself. Like the tools that are available today, and have been for the last several years. They basically can eliminate the banks. Not eliminate them, but make them not as important.
That's right.
For your investment portfolio.
That's right. A bank is a place you should borrow money from, not a place you should go to investment advice. Any place that sells you a 29% credit card is not the place you should go for investment advice. Any place you go for a loan on a car over 84 months that you can't afford, and your car payment is now more than what you put in your investment accounts every month, should not be able to give you investment advice. Anyone who will finance a trailer over 20 years 20 years for a trailer is not an institution who should be in charge of your finances, because they don't care about you. They just don't care about you, right? They have no scruples whatsoever. Not that the person you're dealing with doesn't have any scruples, but the entire doctrine that they get to, it's like they just have to obscure it from those people that are selling those products, right? Because they're from outrageously openly confiscating your wealth to covertly. And that's how those things work, right? And so what we do at the boot camps, we sit people down. The first thing we show them is like, here's how money actually works. Here is the real definition of money. Here's what the real rate of inflation is. Okay, once you understand the thing that you're counting, you understand real inflation, you understand your hurdle rate. Well, let's figure out how it's taxed. Let's teach people how it's taxed, right? This is the stuff that we should have taught in school, right? Let's teach people the different types of income, how other income is taxed, how foreign dividends are taxed, how interest income is taxed, how ordinary dividends are taxed, how eligible dividends are taxed, how capital gains are taxed, how lifetime capital gains exemption works, like how of that all fits together. What's your average rate of return on real estate? How you can borrow against the real estate? What the average amount you can borrow on the real estate is, and how you can actually leverage that and put it into investments that outperform that hurdle rate. We teach people that on a Saturday. And that's how we do it. So what could this person have done is they could have bought a $200 ticket to our boot camp. And it would have taught them more than their advisor, who's confiscating probably 2% of their wealth every year on a management fee, not caring at all, either not caring or not knowing that they're walking towards this problem that should have been painfully obvious for a decade before this happened.
I agree. And it's eye-opening for people when they come and they realize that, what they've been sold is a lie. And
it's the hardest part. It is the hardest part about advising people, where the real strategy is so polar opposite to the mainstream 5 big banks, that it's just like, it's hard to wrap your head around. It's like it's hard to know that you've been given such bad advice for that many years, right? And that everyone does it, right? And I tell people, it's like, just remember COVID. Just remember when you saw the people wearing the masks alone in the car. Just remember when you saw them wearing the masks alone on the Zoom meeting, and they told you it was normal, and most people just bought it. They just bought it, right? And so, unfortunately, as humans, we have prehistoric brains. We have prehistoric brains which tell us to follow the crowd, because if we don't follow the crowd, we eat the wrong berries or fall off the cliffs or get eaten by the tiger. So we don't have a good mechanism to evaluate risk, because we think doing something different is likely death. It's like, no, doing something different is not likely death. Doing something different is a potential way out to the almost certain confiscation of your wealth by financial institutions and the tax authorities.
Well, there's the people who want to do the pattern recognition and do what everybody else is doing, but also remember lemmings, right? Lemmings, they'll follow each other off the cliff. That's what I think a lot of Canadians are doing. They're just following the same financial advice from the 5 big banks and insurers out there, and they're leading themselves off a cliff. I think we had a podcast on Canada going towards a fiscal cliff, and it's, if you guys really knew how bad it is, you would do anything to get on the freaking life raft today. Get to the boot camp. We're not the only people who have the answers out there, but we have an answer. We have a way out. We have, plans that can help you no matter what income level you're at.
And they're do-it-yourself plans, because a lot of people, they're not ready. I saw a headline just before a boot camp saying, Carney's going to introduce automatic tax filing. Great, finally, because we get a lot of people who come to us like they're not ready. So that's why we did the boot camp, because like we show them how to get ready where we can actually do some high level planning. This person was ready for the high level planning, right? But a lot of people starting out, they just, how do you get your first $100,000? I'll teach you how to do that. Teach you how to get your first $100,000. How do you get that actually liquid? How do you actually acquire that house? Because people say, it's like, I read in the comments, it's like, I'm making $100,000. I'm working 2 jobs. I don't know how to acquire a house. It's like, it's a real problem. I feel for those people. And it's like, we can't make money with them one-on-one because they can't afford our services yet. We get them to the boot camp. We give them a plan. Here's how you get there, right? And then for the other people who, they've been in this PsyOps for so long, we actually teach them some money and wealth, right? And I teach them, I was like, hey, go back and ask any of your advisors working for you if they could define the 3 characteristics of money. Watch them all squirm because they can't even define the 3 fundamental characteristics of money. Like, that's how broken this thing is, right? I start to ask them, it's like, how much gold do you own? What's the average rate of return on gold? What would happen if I bought gold instead I bought this thing that you're selling me?
Oh man, they'd be stumped at that.
Yeah,
right?
like once you start asking those difficult questions, it's like you will, even if you're not ready yet, you'll leave with at least the uncomfortable questions. You can go back and ask your advisor and watch them squirm, and then at that point you should run, right? Like I tell everyone, it's like this is 2025. Stop taking advice from no coiners.
Yes.
Stop taking advice from no coiners. I have 0% of my wealth allocated to Bitcoin. I'm just waiting for the point where RBC adds it, 1% of the portfolio into Bitcoin. I just want to troll them so hard because look at the destruction of wealth. I've been yelling from the mountaintops since 2022 that you need to have a percentage of your net worth in Bitcoin and gold. You need to.
Yeah.
It's a massive risk, right? If you don't. And what percentage of the people actually have a portion? 0. You know what I mean? Like,
not enough.
Like 5% maybe, 5%, right? I feel like most of them are at our boot camp every year, right? And at some point they're going to need security for the ones who've been really listening, right? So,
well, something interesting I was reading, Robert Kiyosaki had a post on X today.
Yes.
And I was reading through it, and he's saying, for years they've been telling you to have the 60-40 split, 60% stocks, 40% bonds. Now they're actually shifting that strategy to a 60-20-20.
I heard
right?
one of the institutions says 60-20-20. They went 20% to gold. I think it was Citadel,
gold,
and they went 20% to gold. I saw that headline too, right? I was like, okay. The question you asked is like, at least they went first. How did they miss this over the last 3 years, right? With all of the researchers, it was like, how did a 30-person firm like us uncover the obvious data? You know what I mean? Because when you stopped listening to the rhetoric and just looked at the numbers, it's like the devaluation of the currency was 100% certain in 2022. Like 100% certain in 2022 that you needed insulation from this, right? And some of the hardcore Bitcoiners out there is like, Josh, you were late. It's like, fair criticism.
Yeah, thank you.
Fair criticism. Thank you, right?
You get it at the price you deserve, right?
Yeah, we all get it at the price we deserve, right? But like, how in 2022 are we still, talking about this? Like, the money's going into an RRSP, and like, we haven't even addressed the single biggest risk within RRSP. It's like, okay, you want to die. Everyone's going to die someday. Okay, can't help that. But what if you want out one day?
Yeah.
What if you want out one day? What if you see it's like, I got this money and I don't like where this thing is headed. I want to leave. What's a useful tool to dissuade people from the massive tax bill cashing out of your RRSP, people? That's it, right? You also look at what are the qualitative considerations? How flexible am I in this, right? It's like, nobody looks at this with for example, like real estate. Okay, your principal residence is tax-free now. What if it's not someday? What if it's not, right? What if it's not? Do you really think that it's going to be tax-free for the next 20 years? You really think someone can have a $10 million paid off principal residence and they're not going to come looking for that? It's like the signs on the wall are obvious and people have zero flexibility in their position because they don't know how to get out. It's like, we're about to get a budget. We're about to get a budget in November. there's a reason why they did it in March and April for years, because you'd have some reasonable time to plan around the new rules. You get the rules in March and April that will be effective January 1st next year. They're going to give us the rules on November 4th. And pretend that pertains to a big piece of real estate. And let's just say that capital gains rate is going back from 50% inclusion to 2/3 inclusion. Guess what? We're going to find out about it on November 4th. What's your options to list your real estate and sell it by December 31st? Pretty darn limited, right?
Limited, yeah.
And so, like, is that, late budget? It's basically, like, it's effectively retroactive tax rules. Like, there was no way out. You found out the rules before, further than you could do something, because that, less than 60 days is just largely symbolic at this point. Like, it wouldn't be enough time to actually execute anything. And I think that's the design. I think that's the purpose of the November budget. It's to trap people even further. Now they have even less time to adjust, that there's going to be more changes happening, and you're going to have less notice of those change.
Yeah.
Right?
Well, like we've discussed many, many times, just in our private conversations, that they're coming for your house. They're coming for it all.
They're coming for it all, and they're going to start with real estate.
Yep.
It's where most of the wealth is. So when you're starting at the top, it's like, we're broke. The governments around the world, they're broke, and they're not going to balance budgets because nobody's ready to vote for that yet. So they got to go after large amounts of wealth. Where is that? It's in real estate, people. It's in real estate. They're going to come looking for the real estate, and real estate is, somewhat the worst. It's somewhat the hardest to protect because it's really obvious that you have it. Yeah. It's easy to confiscate. You have to deal with all three levels of government: the federal government, the provincial government, the municipal government, and they can tax it through, effectively confiscate it through taxation or regulation.
Yeah.
And it's hard to move, right? They're a little more concerned about making changes to the market because the most liquid people, if they sniff out a change, can cash out on a Monday and have that wealth in another country on a Tuesday.
Yes.
Real estate's a little harder to do that with, right? Even at a high level. So, people have no flexibility in these plans whatsoever. In your RRSP, like, no flexibility. Even, looking past the tax strategy, it's like you're really limited, people. Well, because those tax rates every year, we show people the tax rates and the tax brackets at the boot camp. It's like those tax brackets go up by the fake government inflation rate every year. So they're increased every year, but the stuff you want to buy goes up by the real inflation rate. And we show you this at the boot camp, how much, these things go up in relation to the CPI that the government tells you. So if you're living comfortably in the second tax bracket today, that second tax bracket isn't going to feel the same way 10 or 20 years from now, right? And so, the idea is to take, put money in an RRSP at one rate and take it out at a lower rate later. It's like the same tax bracket is not going to feel the same 10 or 20 years once you understand how the inflationary monetary system works, right? Yeah. That's baked into it. That's why you end up with a tool that probably should be used in 1% of the scenarios, used 99% of the times, because they don't understand it, right? And they don't understand money at a fundamental rate, that this entire system is designed to move the money from the people who do the work to the people who know how to borrow smartly to invest. And what's the hardest thing to leverage against? Your RRSP, because it's creditor protected, which should be a benefit, but that means you can't leverage it. You can't leverage it, which is the way that you really build wealth, right? So that's that's kind of what I have there. I hope that's helpful for somebody. I hope there's someone out there who sees, like, I've got a few $100,000 in RSP, and no one has ever talked to me about how this is taxed on the way out. No one has ever talked to me about how do I actually leave some of this to my kids? No one has talked to me about how I'm actually going to not run out of money. And even if they have, I start to see it's like, you use a 2% rate. Use a 2% rate there. So, that's, hopefully that is helpful for somebody, because, there's a lot of Canadians walking towards this with a significant portion of their wealth in RRSPs, and they have second properties, and they have no tax minimization strategy on it. They sit down with someone and they tell them that they have this property, but no one tells them this is the tax bill on it, or this is how you actually avoid the tax bill. Don't listen to that guy who says, here's the expensive insurance product to buy to pay that tax bill. The goal is to not pay that tax bill. That's the goal, right? To put yourself in the situation that you don't have to pay it.
Yeah, that's right. And guys, we got 10 tickets left. That's it. That's all. And then we're sold out. We're completely done. So get your tickets today. The chat's blown up. Did you want to look at any of that?
Oh man, yeah. Let's see what are they asking there, Trevor?
All right. So let's see here. Oh boy, chat's blown up. Are these guys CPAs?
I am. Trevor's not.
I'm not.
Yeah. Trevor's a licensed mortgage broker.
Yeah.
And I'm a CPA. So.
That's right.
If I'm not wrong, gold up 100% in the last 5 years, and Bitcoin is up 1,000%. Yes, thank you. Thank you for someone who actually looks at the numbers and doesn't just listen to the talking heads about what you should be scared of. Thank you very much. Carry back losses from the sale of the cottage, if any, in the last year. They unfortunately, these people probably didn't have any losses, and yeah, that is a rule, but there was a better rule. Potentially there was a opportunity for a holding company to go in there and actually convert the extraction of that wealth using eligible dividends. But
let's not forget the RSP contributions for all those years. And next is if they're T4 earners, RSP is still a very useful strategy.
No, you just don't understand the other strategies. I'm sorry, and I don't want to be blunt because that's what they're told. It's they're told it's a deferral mechanism. It's a deferral mechanism only. They just don't understand the other strategies. They don't understand the leverage strategies. They don't understand the intergenerational wealth strategies. They don't understand estate freezes. There's so many other tools that they have at their disposals. They just weren't sold at RBC.
Gotcha. What we're seeing is the FV of the PVs of every deduction.
The future values of the present values of every deduction. Yeah, I mean, it's they tax you on the appreciation of assets, but they've created that appreciation by inflation. That's it. You're still holding the same asset. You're still holding that same cottage, and sometimes it hasn't really increased by more than the actual inflation rate. But now they want some of it. When it's still the same cottage, it still has the same value as when you bought it. It just appears higher in fake paper currency because they inflated it, right? So
all right. Eric is talking about bond yields going to collapse as boomers retire, as they move from equity portfolios to fixed income portfolios.
I mean, will the bond yields collapse? But who else wants to take the other side of that trade, right? So what you're going to see is more likely what you see in Japan, where the central banks have to actually control that yield from spiraling out of control, because more and more people are going to understand. It's I don't want a 30-year trade at the government for 4% interest. You're going to print 8% new money every year, which we show everyone the money supply at the bootcamp and how this is done. It's they're going to print 8% new money every year and give me and grow the population by 1% and give me a 4% rate of return. It's just a destruction of wealth. Yeah. And so, will those bond yields collapse? It's no, I actually think that they'll have to do work to control them. So,
all right. No Name Extra says, this is too much work for anyone to follow. Move funds here, then there. Just self-custody Bitcoin in your cold storage and transfer the keys to your kids or grandkids.
It is I have this is really good, right? And I tell everybody very much up front, there's an 80% chance that you're just going to wish you bought Bitcoin and that sold everything you had and bought Bitcoin. Any advisor who doesn't sit down and have that open, honest discussion with you, that is a very likely scenario that Bitcoin outperforms everything. Great. But then you have to also look at the what ifs too, right? You have to look at the what ifs. Can governments change? In the end, I think Bitcoin wins. I do. I really do think that happens. But they're underestimating the difficulty that governments can make in your life in the medium term. And when I tell people short term, I mean everything in a year. Medium term, I mean anything in 10 years, where you might have a bunch of Bitcoin, but you're going to have trouble cashing it out. You're actually going to have trouble living well for a period of time, right? And I still think that there's an 80% chance of success rate. So am I 100% Bitcoin maxi? I'm not there, but I would say most of the 100% Bitcoin maxis are more prudent than the people in a 60-40 split, for sure. Right. That's a higher probability that's going to work out.
Yeah,
so
I got you.
Yeah.
All right. Okay, so I'm not sure which one you want to tackle.
CRA requires a deemed disposition on death. Yes, that's exactly what the triggered this whole thing. How about no taxes? Yes, I agree. Like no taxes. There are ways to significantly reduce these tax bills.
Yeah. Already paid taxes for my paychecks. Enough is enough.
It's true. Like that property they bought, like they earned income. They were taxed on that earned income. Then they bought the property when it was new. They charged GST or HST on the property, and then they confiscated a little bit of it every year through property tax, and then they inflated the currency used to measure it year by year, and then they wanted the tax on that too.
Yes.
It was tax on tax on tax on tax on tax.
Yeah.
Right. That's what it was. So
we're on a tax farm, folks. Retirement is a Ponzi. Absolutely. RSP, still money in the system. Ever heard of a bail-in?
Bail-in. I think I need a little more info on that one.
Yeah.
This is just silly. You can't be restricted in Canada and get money out of the system by buying crypto.
Can't be a resident in Canada and get money out of the system by buying crypto.
You can't be a resident in Canada and get money out of the system by buying crypto. It's just more portable. Your crypto is still reportable. Yes, yes, but it is also insurance. I think people are underestimating the chance that things could the likely outcome for a lot of people is you're probably going to want to move someday. Like I'm. Like I freak people out sometimes when I say that, right? But at least you have the choice to move. Maybe your other accounts are frozen while you're working out your tax bill, but your crypto is not. And depending on how oppressive things are you going to pay the bill or are you not going to pay the bill? Right now, pay the bill. Pay the bill is the way to go. But at least you have the flexibility, right? But you're starting to think the on the right thing here. So
right.
Money under the table. This is good. Everyone think like money under the table. No, it's not useful because I can't leverage it. I can't sit on this money here. I have to get it on the system and buy real assets. I have to take the fake money and buy real assets. So money on the table, you're just going to get it taken by inflation. And so that's a common misconception where people think it's like you have to play the game the way that it's set up, right?
Yeah. See here. Leave Canada if you don't want to pay tax. Exit taxes deemed disposition.
Yeah, and actually that's a viable strategy for more people than they think. So there are ways out. In this case, there was ways out with these people not leaving for sure, right? That could have been addressed. But for some people, it's just going to look like at some point if you want it even lower, Canada's not the place for the lowest. That's right. True. Yeah.
Okay. Stephen Smith says they can confiscate file any minute. Is that not what the Americans did in the past? What happens then?
Maybe he's talking about the gold being confiscated, right?
Yeah.
Which is a realistic risk, right?
Yeah.
No one is doing 2/3 inclusion rate. I don't know. Like, I hope you're right, but I think you should be prepared for that. So I actually think that's inevitable. It used to be 3/4 people. Yeah. So I've done taxes long enough to know that it used to be a 3/4 inclusion rate, and then it fell to 2/3, and then it fell to a 50% inclusion rate, and then they threatened to bring it up to 2/3 again, and then Christy Freeland dropped off the budget like a illegitimate child to the parliament, and government fell, and Trudeau lost, and we got Carney. So like I think it's going back up there again. Yeah. Is it this year? Not sure yet, but it's possible.
So the fear mongering. Okay. Steve, perhaps the preppers have the right idea. Invest in guns and ammo. LOL.
I hope we never come to that, but I do own guns and I do own ammo, so I don't know. I hope that's never the right plan, but they don't need to do a 2/3. I mean, they don't need to do any capital gains inclusion, but we don't actually understand how taxation should happen. Yeah. So.
All right, Steve Smith, either way, they can tax you right out of any asset when houses are appraised at 3 times their actual value. Who can afford property taxes at that point? Agreed.
True, exactly. Yep. They inflate the value of their property up and then confiscate that extra property tax year after year. This is a problem. Yeah.
I'm 100% in Bitcoin and in self-custody cold storage. Awesome. He's a maxi. He's a maxi.
He's a Bitcoin maxi, right?
Crypto Canuck. Bitcoin maxis everywhere. How about other cryptos? Or better yet, go private. Number 1, number 2.
I mean,
always go with number 1.
I only own Bitcoin. That's me. Like, I only own Bitcoin at this point. Like, people don't understand, like, the things that I'm saying might sound radical. I'm actually very conservative. I'm actually like a pretty conservative investor. It's like, do I think I can make some money off an XRP trade? I can, but it's a trade, not an investment. I like to invest in things that I think I can hold for 100 years. Yeah. And it helps me make better choices of my investments, right? Yeah. And I'm fully prepared for, a 50 or 80% drawdown in my Bitcoin, and I won't be selling. I mean, when I started buying at $40,000 a coin, it's like it went to 20. I kept buying. Yeah, I wasn't rattled because like I when I start entering a position, like I entered it to hold the position, right? People, you see that now they buy some real estate, and maybe they bought some real estate in Ontario, and it's like, oh, it's down 10 or 20%. It's like, why should that have changed anything, right? You shouldn't have bought something that if it went down percent, you're going to get margined out of this position, and it shouldn't rattle your thoughts on this position. You should have bought something that you thought you could hold for 100 years.
Yeah. It only matters when you sell.
That's right.
Yeah. Okay. Well, thanks, chat.
Yeah.
Appreciate it. Thanks for joining in the chat today. And, we still have a few tickets left at the boot camp. So that's a place where you can learn all the strategies, figure out, when the money system really started its downward spiral and when it accelerated and how you can plan for the future.
Right on, guys.
All right. See ya. Bye.